There is a transaction that tens of millions of Americans complete every year that feels, in the moment of completion, like a reasonable and well-considered financial decision. The monthly payment fits within the budget. The interest rate is lower than expected. The trade-in value came in close to what the online estimator suggested. The salesperson was helpful in the process, while lengthy produced an outcome that felt fair. The buyer drives off the lot in a vehicle that is newer, nicer, and more capable than what they drove in with. And the satisfaction of that moment is real and immediate. What is not real and immediate, what will not become visible for months or years, or in some cases decades, is the full financial cost of what just happened. Not the sticker price, not the monthly payment. The complete, total, fully loaded cost of the vehicle acquisition decision calculated across the realistic ownership period and compared to the alternatives that were available but not seriously considered. This number, which almost no car buyer calculates before signing, is almost always dramatically larger than the number the buyer has in mind when they make the decision. And the gap between the number in the buyer's mind and the actual number is one of the most reliably expensive misunderstandings in personal finance. Let us build the real number together, because seeing it constructed piece by piece is the only way to understand how the components compound into something that most buyers would find genuinely alarming if they had seen it before signing rather than after. Start with a new vehicle purchase that is representative of what a typical American buyer finances today. A mid-size SUV with a purchase price of $45,000. A down payment of $5,000, leaving $40,000 to finance. A 60-month loan at 6% interest, which reflects a rate environment that has been common in recent years. Monthly principal and interest payment of approximately $773. The total of 60 monthly payments of $773 is $46,380. Add the $5,000 down payment, and the total out-of-pocket cost of financing this vehicle over 5 years is $51,380 on a $45,000 vehicle. The financing cost alone, the interest paid over the life of the loan, is approximately $6,380. This is a number that most buyers are vaguely aware of and have factored into their thinking, at least in general terms. It is the first layer of the real cost, and it is the layer that the monthly payment framing is designed to make feel manageable. Now add the costs that are certain but frequently underweighted in the pre-purchase calculation. Depreciation is the largest single cost of vehicle ownership and the one that receives the least attention in the buying decision. A new vehicle loses approximately 15 to 25% of its value in the first year of ownership. On a $45,000 vehicle, that is between $6,750 and $11,250 of value lost in the first 12 months, during which the buyer is also making loan payments. By the end of the 5-year loan term, the vehicle that cost $45,000 to purchase will have a market value of approximately $15,000 to $20,000, depending on the make, model, mileage, and condition. The $45,000 asset has become a $15,000 to $20,000 asset in 5 years of normal use. The depreciation loss over the ownership period, meaning the difference between what you paid and what the vehicle is worth when you're done with it, is between $25,000 and $30,000 on this example vehicle. This loss does not show up in your monthly budget as a line item. It does not trigger a notification or statement or any visible event that draws your attention to it. It simply accumulates silently in the background while you make your monthly payments and enjoy the vehicle, and it only becomes fully visible when you try to sell or trade in the vehicle and discover what it is actually worth, relative to what you paid. Add insurance costs. A new $45,000 SUV requires comprehensive and collision coverage that is significantly more expensive than the liability coverage that would be sufficient for an older vehicle with no loan balance. The average annual cost of full coverage auto insurance in the United States is approximately $2,000 per year, though this varies dramatically by location, driving history, age, and coverage levels. Over a 5-year ownership period, insurance costs on this vehicle total approximately $10,000. Add fuel costs. A mid-size SUV with average fuel economy of approximately 25 miles per gallon, driven the average American mileage of approximately 15,000 miles per year, consumes approximately 600 gallons of fuel annually. At an average fuel cost of $3.50 per gallon, annual fuel expense is approximately $2,100. Over 5 years, total fuel cost is approximately $10,500. Add maintenance and repair costs. A new vehicle under warranty has minimal maintenance costs in the first few years beyond oil changes and routine services. But as the vehicle approaches and then exceeds the warranty period, maintenance and repair costs increase. The average American spends approximately $1,200 per year on vehicle maintenance and repairs across the ownership period of a new vehicle. Over 5 years, that totals approximately $6,000. Add registration fees, which vary by state, but average several $100s per year across the country. Over 5 years, registration costs total approximately $1,500. Now add all of these components together and look at the real number. Financing cost over 5 years, including the down payment, $51,380. Depreciation loss over 5 years, $25,000 to $30,000. Insurance over 5 years, $10,000. Fuel over 5 years, $10,500. Maintenance over 5 years, $6,000. Registration over 5 years, $1,500. The total cost of owning this $45,000 vehicle for 5 years is approximately $104,000 to $109,000. For a vehicle that cost $45,000 to purchase, the complete cost of ownership is more than double the purchase price, and none of this accounts for the opportunity cost of the capital deployed, meaning the return that the down payment and the monthly payments could have generated if they had been invested in financial assets rather than directed toward vehicle ownership. If the $5,000 down payment and the $773 monthly payments had instead been invested in a diversified stock market index fund, generating the historical average annual return of approximately 7%, the value of those investments at the end of the 5-year period would be approximately $54,000. The opportunity cost of the vehicle, meaning the difference between the total cost of ownership and the investment value that the same dollars could have produced, is a significant additional component of the real economic cost of the decision. This is not an argument that owning a vehicle is irrational. For the majority of Americans, vehicle ownership is a practical necessity rather than a lifestyle choice. The argument is that vehicle decisions are consistently made with dramatically incomplete information about their real economic cost, and that the incompleteness of that information reliably produces decisions that are more expensive than they would be if the real cost were understood before the decision was made. Let us look at the specific decision-making dynamics that produce this outcome, because understanding them is the beginning of making different decisions. The monthly payment trap is the foundational mechanism that distorts vehicle purchase decisions more than any other single factor. When a purchase decision involves a large sum of money, the human brain struggles to evaluate the total number meaningfully. $45,000 is difficult to compare against other things a person might do with $45,000 in a way that produces a clear and emotionally resonant conclusion. $773 per month is easy to compare against monthly income, monthly rent, monthly groceries. It fits within the familiar framework of household budgeting that people use to evaluate ongoing expenses. The automobile industry understands this cognitive dynamic intimately and has structured the entire retail experience around it. The negotiation that happens in a dealership is almost never primarily about the purchase price of the vehicle. It is about the monthly payment. The salesperson asks what monthly payment you are comfortable with rather than what total price you are willing to pay. The financing options are presented in terms of monthly impact rather than total cost. The trade-in is evaluated and presented in terms of how it affects the monthly payment, rather than as a separate transaction with its own financial logic. Each of these framings is designed to keep the buyer's attention on the number that is most manageable and least alarming, rather than on the number that most accurately represents the economic cost of the decision. The monthly payment framing is not deceptive in a legal sense, but it reliably produces purchase decisions that would not be made if the buyer were evaluating the total cost of ownership rather than the monthly affordability of the payment. The second dynamic is the new versus used decision that most buyers make without conducting a genuine economic comparison. The primary argument for buying new rather than used is reliability and warranty coverage. New vehicles are less likely to require unexpected repairs during the ownership period, and warranty coverage reduces the financial impact of repairs that do occur. These are genuine advantages that have real economic value, but the depreciation curve of a new vehicle is steepest in the first 1 to 3 years of ownership. A vehicle that sells new for $45,000 and is 2 to 3 years old with normal mileage will typically sell for between $28,000 and $35,000. The buyer of the 2 to 3 year old vehicle is acquiring a vehicle with most of its useful life remaining, similar reliability to new in most cases, and often the tail end of the manufacturer's warranty while avoiding the steepest portion of the depreciation curve. The economic case for buying a 2 to 3 year old vehicle rather than a new one is strong in most circumstances, and the reluctance of most buyers to seriously consider it is more psychological than rational. The new vehicle has new car smell and the satisfaction of being the first owner. It has the full warranty and the comfort of knowing that no one else has subjected it to unknown driving habits or maintenance practices. These are real psychological benefits. The question is whether they are worth the premium of $10,000 to $15,000 in avoided depreciation that buying a comparable used vehicle would produce, plus the reduced loan balance and the lower monthly payments that accompany a lower purchase price. For most buyers in most situations, the honest answer to that question, evaluated without the emotional pull of the new vehicle experience, is no. The psychological benefits of buying new are real, but not worth the economic premium that buying new costs relative to buying a 2 to 3 year old alternative. The third dynamic is the trade cycle trap. The average American replaces their vehicle every 6 to 8 years. Many replace more frequently, driven by the desire for a newer vehicle, changing lifestyle needs, or the end of a lease period. Each replacement resets the depreciation curve, meaning the buyer absorbs another round of first-year depreciation loss on the new vehicle while simultaneously accepting whatever the market will pay for the vehicle being traded in, which reflects the depreciation that has already occurred on that vehicle during their ownership. The most economically efficient vehicle ownership strategy, which is also the strategy least likely to be recommended by anyone who profits from vehicle transactions, is to purchase a vehicle with a strong reliability track record, maintain it properly, and operate it well past the point where the loan is paid off and through the period of ownership where the per-year cost of the vehicle is lowest because the fixed costs of purchase are being amortized across an increasing number of years. A vehicle purchased for $45,000 and operated for 12 years costs significantly less per year than the same vehicle operated for 6 years, even accounting for the increased maintenance costs that come with higher mileage and greater age, because the depreciation and financing costs are spread across a longer period. This strategy requires overcoming the psychological discomfort of driving an older vehicle in a culture that associates vehicle newness with status and success. That psychological discomfort is real. Its financial cost, measured in the premium paid for operating on a shorter replacement cycle, is also real, and it is substantially larger than most people who feel the discomfort have calculated. The practical framework for making better vehicle decisions is straightforward, even when it's not easy to implement given the psychological dynamics at play. Calculate the total cost of ownership before making any vehicle decision, not just the monthly payment. Include depreciation, insurance, fuel, maintenance, and registration in your calculation. Compare the total cost against your annual income and your other financial priorities, including retirement savings, emergency fund status, and debt position. A vehicle whose total 5-year cost of ownership exceeds half of your annual gross income is a vehicle whose economic impact on your financial life is significant enough to deserve that level of deliberate analysis. Consider seriously the 2 to 3-year-old alternative to any new vehicle you are evaluating. The economic case for it is strong in most circumstances, and the reliability concerns that make buyers hesitant are frequently overstated relative to the actual reliability data for most mainstream vehicle brands. Evaluate the true cost of your trade cycle by calculating how much depreciation you have absorbed on your current vehicle since purchase. That number, which you can estimate by comparing your purchase price to the current market value of your vehicle, is the cost of your current replacement cycle. Understanding it concretely rather than in the abstract frequently produces a recalibration of the replacement timeline that the economic data supports. And recognize that the monthly payment is not the price. The total cost of ownership is the price. The monthly payment is a financing arrangement that spreads a portion of that price across time. Keeping that distinction clear in your evaluation of any vehicle decision is the single most important cognitive shift available to anyone who wants to make vehicle decisions that serve their financial life rather than undermine it. Next week on Quiet Rich, I'm covering the research on why the most intelligent and financially sophisticated people consistently make the worst investment decisions, and what the psychology behind that counterintuitive finding reveals about the cognitive traps that affect every investor regardless of how much they know. Subscribe so you do not miss it. New videos every Tuesday and Friday.